Global Financial Management, Topic 1, Assessing and Managing Country Risk, copyright Lou Gass. In this topic, we'll look at the rationale for a corporation going global, some global trends using maps, and how to measure and mitigate country risk. So the first question is, why would an organization decide to go global? There's many reasons. The historical first reason was to obtain raw materials, historically through the 16th, 17th centuries to obtain metals and spices. There's also more recently to lower production costs, distribution and servicing costs. So this is your outsourcing justification. It could be just to increase sales to a new and growing market. Obtain global talent and ideas. Tax or regulatory arbitrage. You might find you can create some kind of tax benefits by moving some operations offshore. Access to global capital. You may find that your nation has a smaller developed capital market, so it might make sense to go to a larger capital market to, say, borrow and invest money. Global diversification. If you're a country that has significant exposure to the business cycle, by being in a number of locations, you have less exposure to a single business cycle. And the last one could be a response to a competitor who has gone global for any of these reasons. So let's look at some maps to kind of think about global opportunities. This is a map that shows the leading exports of either raw materials or capital goods by country. What stands out first to me is the petroleum exporting countries in North, South America, North Africa, the Middle East, Russia. What also stands out to me is the countries that specialize in textiles or apparel, manufacturing of clothing and shoes and things like that. And what you find is these are some of the cheapest areas to get labor. So this would be Mexico, some parts of the Middle East, Africa, some parts of Asia. And then you have some of the richer countries that are known more for manufacturing. And this would be the US and Canada, Brazil, China, and most of Europe. And you have some commodity countries, for example, Australia specializing in coal, Chile specializing in the export of copper, South Africa, gold, diamonds, and such. And also India, some special stones or precious stones. Another reason why you want to go global is just to find rich countries or countries with high incomes that you can export their goods. So we're talking about the rich countries, say incomes with high or countries with high income as defined by the OECD, $12,000 or more. We're talking about Australia, Japan, North America, US and Canada, Scandinavian countries, sometimes just called the Scandies, Great Britain, and Europe, including Greece, and we can also throw in here Saudi Arabia. If you're looking for just the number of consumers, just not the wealth of consumers, we're talking about the largest countries as far as populations. We're talking about China, which has almost 20% of the world population, followed by India, then the US, Indonesia, Brazil, Pakistan, and the rest. If you're looking at where the populations are going to grow, this is a projection of populations from 2010 to 2100. We see that India is expected to be the largest population base, overtaking China. And then we have Nigeria coming up rapidly over the next 100 years, and then the United States, and then you see a new country pop in here, Tanzania. And then we have the rest, Pakistan, Indonesia, and others. You may be going global just to find growth. This is a growth forecast or a historical growth from 2010 to 2004. And what you see is generally the richer countries are showing kind of the moderate to low growth. And where you find the highest growth are the poorer countries or developing markets of China, some of Africa, South America, Eastern Europe. Related to the idea of going global for outsourcing, this gives you an idea of where the cheap labor exists. So this is average hourly compensation for manufacturing and others in 2012. And what you see here is a range for each country. So let's look at the United States. The cheapest labor in the United States is in the apparel industry for manufacturing of clothing and such. And the most expensive labor, like many countries, is in petroleum. And what you see in the United States, the average hourly wage is about $20 some, say low 20s per hour. And for petroleum and coke, it's almost $60 an hour. And you can compare this to, say, some of the cheapest places in the world to produce goods. As far as apparel goes, you can see that it would be hard for a U.S. firm to compete in the apparel market when Poland, Hungary, Thailand, Estonia, Brazil have costs that look like they're between, say, $5 and $10. So 1/4 of the cost of the U.S. And you can see some countries like Belgium have almost $40 apparel. So this gives you an idea of where the cheap labor is, but also knowing there's a continuum. For example, if you look at Korea, they have very cheap, relatively cheap textile labor, but relatively expensive petroleum labor, so quite a range. Or other countries like Mexico, the range is very narrow. All labor seems to be relatively cheap. And for, say, Norway, range is relatively narrow but very expensive. So this is looking at hourly compensation. But if we expand that and think about, well, total production costs, it's more than just labor. So here's an interesting index for 2014. Here's the United States, indexed at 100. And what this is total manufacturing labor cost, including labor, electricity, natural gas, and other expenses. So once you see this, you can see that U.S. is relatively cheap in the world. Although India is much less, Indonesia much less. But you can see other areas like Australia, France, Belgium, very expensive, including the cost of these other goods or other sources of manufacturing costs. This looks at it a little bit differently. This looks at just wages and some changes. So the median wages in this 2014 were $17 an hour. The highest wages were $35 per hour in Switzerland, and the lowest, less than $1 per hour in India. But it also looks at exchange rates. If you're saying manufacturing in euro and the euro is appreciating, that's going to increase the cost of, say, a US dollar cost of manufacturing. And what we see is the Indian rupee is devaluing over this period of time, and the Chinese yuan is appreciating, or the renminbi. So that's eroding the Chinese advantage. This is an interesting listing of countries. They're looking at what they, this particular group, the BCG, is looking at different groupings of countries. And what they say are these are countries that are traditionally low cost, which includes Brazil, China, Czech, Poland, and Russia. But there's deteriorating competitive driven by a range of different factors. So these are an idea is like these are the falling stars of the new outsourcing boom, including China, which is related to the fact that the Chinese yuan is increasing and labor costs are increasing. Interesting also in this list is the rising global stars of Mexico and the United States. So they're showing that there is improvement due to slow wage growth, which has been an issue in America. However, for manufacturing, that's a bonus. You have slow growing incomes, makes us more competitive at these other areas, show higher incomes. Although I'd probably at this point in time start moving the U.S. into maybe one of these categories, as the dollar has been very strong over the last 3 to 6 months. That's increasing the cost relative to these other countries. Another way of looking at opportunities is how easy is it to do business? How easy is it to set up a business in certain countries? So this is the doingbusiness.org. They have country profiles and world profiles, and what they look at is factors like how easy is it to get a building permit? How easy is it to start a business? And what they find is the easiest places to start a business are the U.S., parts of South America, including Chile, most of Europe, although Italy's a little bit tougher, you can see, and Greece, Australia, and you can see the tough places to generally start a business, or at least tougher, with Brazil a little bit on the lower side as far as ease of doing business. And here's just a profile actually for Brazil from this doingbusiness.org, and you can see why they rank relatively low. Dealing with construction permits, they rank 174th. Paying taxes, the difficulty of paying taxes. So this might look at factors like how long does it actually take to fill out a form to pay taxes, how difficult is it to pay taxes, how long does it take, and how many people you have to talk to say register property. And these are the things in which Brazil is doing poorly. So we talked about the opportunities of going abroad and a little bit about the difficulties of going abroad as far as setting up a business. Let's talk about country risk. Country risk is sometimes called political risk. It's just a term that's used to describe the general risk of doing business in a foreign land. Now these risks are many. The number one that we're going to talk about and is a big focus for companies is currency risk. If I'm operating in another country or I'm selling to another country, exporting to another country, you have significant currency risk. Let's take an example that you're a US-based firm and you simply are exporting to Europe or exporting to Brazil. Your primary exposure is to a depreciation of, say, the euro, or a depreciation of the real, or an appreciation of the dollar. Right? If this were to happen, say, increasing the value of the dollar, or in other words, the foreign currency is devaluing in terms of dollars, the revenues that you're generating, say the euros and the real, that you're generating through your sales, when you go to sell the reals, or the reais, and the euros, you're going to get less dollar because the foreign currency is depreciating. So that's going to hurt your bottom line. Also, as the dollar appreciates, your goods look relatively expensive to foreigners, so maybe they find other exporters in different countries. So as an exporter, your primary focus or risk is to an appreciating dollar, depreciating foreign exchange. And this is what's happening today. The dollar is up greatly, if you notice lately, against many foreign currencies. In other words, many foreign currencies are weak against the dollar, including the euro right now. It's trading about 105. As an outsourcer, say you're a US-based firm, but you have manufacturing in India or manufacturing in China, your primary risk is to an appreciation of the foreign currency. So it's going to cost you more dollars to pay off your Indian labor that's paid in rupee. It's going to cost you more dollars to pay off your Chinese labor that's paid in yuan. The other risk includes sovereign debt defaults. So this will be a default of a foreign country's bonds. Now, this may not affect a multinational, say, manufacturing firm, but it generally also is associated with banking risk and government sector risk as they try to reduce costs to get the budget back in line. And it can lead to a general economic crisis, which leads to the next risk, which is a general macroeconomic risk. So exposure to fall in production or incomes in that country or rise in their inflation. Other risks include terrorism, violence, corruption, infrastructure risk, the risk that your power plants don't get the electricity they need or the water they need, or transportation is difficult or communication is difficult, things like that. There's expropriation risk. That's the risk that your foreign operation is taken over by a foreign government. This doesn't happen as much today because what they do today are other ways of doing expropriation. In other words, they can just use tax policy. They can increase taxes on foreigners operating in their country. Or tax risk also could be a risk that the U.S. raises taxes on foreign operations. There's trade barrier risk. There could be a risk that you're operating over there and then there's sudden changes in the system of tariffs and quotas that make it harder to generate revenue, sell your product. There's regulatory risk. You set up a facility in China or India, and you find that they now are changing the rules for doing business on environmental or labor practices, and that's going to increase your costs. And then you have legal and legislative risk. It's the risk that the courts or juries, find against your corporation and cause increase in costs. This is a map of some political risk by the Aon Corporation or company. And what they show is actually they're not rating the US, Canada, Mexico, and Europe. They're looking at other areas. And what they do is they rate them as far as the places that are the riskiest to do business. And they look at a number of factors, including infrastructure and currencies and government and things like that. And what they find is the riskiest places to do business are in these reds. So this is the Middle East, Central Africa, Venezuela, and this is 2014. This is Ukraine, North Korea, Somalia. And what you see is Brazil is in the same category as, say, South Africa, India, Saudi Arabia, as far as the ease of doing business, Indonesia. Here's a blow up of Eurasia, and again you can see the most challenging places to do business right now are obviously Ukraine, Iran, Iraq, Afghanistan, Syria, followed by some satellite countries around the Middle East, including Pakistan, most of North Africa, including Egypt. And again, you see that the relatively safe areas in this map are India, Saudi Arabia. See, China here has a medium risk, as well as Russia. Here's a little blow up of South America and Central America, and you can see the safest places to do business is Chile, followed by Brazil, Peru, Colombia, Venezuela, obviously the most difficult, followed by the next to most difficult will be Argentina, Bolivia, Ecuador, Cuba, much of Central America, Dominican Republic, Haiti. This is just a chart showing probabilities of a 5-year bond issued by the government defaulting in a few countries. And you can see Argentina from January 2014 to December 2014. It's been running about a 15% probability default. And this is based on prices of insurance contracts, credit default swaps on their bonds. And you can see Brazil, relatively low. And for comparison, we have the United States and Chile. And this is Ukraine. With all this negativity, I thought I'd throw one more chart in there, one more map, and that's the happiness ranking. So where are the happiest places to do business in the world? Where do you find people that are generally happy? And what you find is US, Canada, Mexico, Australia, and then the one you hear about all the time are the Scandinavians, Norway, Sweden, Finland, as the happiest places are people the happiest. I always found interesting on this map, Venezuela is one of the happiest places in the world. You can speculate yourself on why that's so. Now, talking about the risk of doing business, we talked all kinds of risks and opportunities of doing business. How could you manage country risk before the investment even starts? One obvious is avoid areas in which are too speculative at this time. So that would be Ukraine, Russia, areas like that. You can also try diversifying across nations and regions. So try to get operations in many different economies: Asia, Europe, South America, North America, Africa. Next one is obtaining strategic partners to share the risk, to help you enter the market safely. And also, before you even go into a business and you're, say, looking at starting a business there, you need to evaluate how much you'd be willing to, say, bid for a business that's going for sale, or how much you're willing to pay for a factory. You would account for the risky areas by, say, having a higher discount rate. In other words, all else equal, you'll pay a lower price for a risky area, therefore helping your chances of increasing the rate of return. Once you decide to go into an area, one way to mitigating risk is during financing. And if you're worried about a particular area, one thing you want to do is make sure you minimize your financial exposure through financing. So you might want to try to obtain outside financing: World Bank, regional development banks, IMF, foreign governments. Try to get partners to put in some financing, either through joint ventures, licensing, again, full partnerships. You can try project finance. Project finance is if you have a particularly risky project, you could set up the project as a separate legal entity, borrow money in the name of the project. The most famous one would probably be the English Channel Tunnel, the Channel. That was considered such a large, costly, and risky venture that it was set up separate from all the corporations that partnered to do it, and that mitigated some of the risk. Lastly, if you're going to borrow money, I'd recommend borrowing money from a local bank. If I'm going to do business in, say, India, one strategy would be borrow money from a local Indian bank. And the benefit there is you build a local stakeholder. What I'd really like to do is borrow money from an Indian bank that has a lot of political power in the country. So now you have someone that's intensely interested in your success. And also, one we'll talk about later is if you're starting an enterprise, say you're building a factory in Europe to sell cars to Europeans, it might make sense to actually borrow money in euros. You want to borrow money where your revenues are being generated. So, for example, if you borrow euros to, say, build a factory to build cars to sell to Europeans, you're going to generate euro revenues, and it creates a natural hedge if your costs are in euros also, your financing costs. So it's going to reduce the volatility and your exposure to exchange rates. Once you're doing business over there, you continue to try to cultivate strategic partners, other firms that are in that country. Develop local stakeholders. You want to, say, employ the local people, and use the local banks, use local suppliers, even maybe if they're not the cheapest. And what you're trying to do is maximize the reliance of that country on your firm. Build stakeholders that have an interest in seeing you succeed. There's also tax arbitrage, either subsidiary to subsidiary or parent to subsidiary tax arbitrage. A lot of this is done with transfer pricing, that once you generate revenue in a foreign country and you're trying to avoid, say, higher U.S. corporate taxes, there are legal ways of transferring money and using transfer pricing to move the profits around or keep them overseas. You also want to, say, match foreign exchange assets and liabilities. If I'm operating in Brazil and generating revenues, I'm going to have real revenue. I would try to maybe bill suppliers in real also. I wouldn't want to bill suppliers in dollars. That way I have revenue and expenses, assets and liabilities in the same currency. And also I can enter into forward contracts. Forward contracts are contracts that allow you to lock into an exchange rate for several years at least. So if I know if I can forecast relatively consistently what my euro revenues are going to be for the next 5 years, I can enter into a forward contract today to lock into particular exchange rates. So this was a topic that talked about an overview of why a country would, or why a corporation would go global, some global trends using some maps, and how to measure and mitigate country risk.